It is now my pleasure to turn today's webcast over to Rebecca Robinson. Ms. Robinson, you may begin.
Good morning, everyone, and thank you for joining us. I'm Rebecca Robinson. I am the president of Zions Trust here within the Zions Bank family, and I have the distinct pleasure today of also being joined by Chad Oviatt. So Chad is a senior investment manager within Zions Trust, but prior to joining us, he spent a number of years working first in the brokerage industry with both Merrill Lynch and Smith Barney, and then subsequently in banking, predecessor bank of Huntington Bank itself, where he held a variety of positions, including their chief investment officer and chairman of their investment policy committee. So today, as we head into this presentation, we wanted to start by really focusing on the planning aspects of why someone invests. At Zions, we believe very, very wholeheartedly that all of your decisions, all of your wealth management decisions should start with a plan based on you and your unique circumstances. So no two plans look alike, no one's life looks exactly like someone else's. So I will start the first part of this presentation today talking about goal setting and understanding why someone might invest. And then from there I'll hand it over to Chad, and Chad will help us go through some of more of the details around different types of investments and some of the choices that go into actually executing on an investment plan. So with that, I would like to begin by posing a question to everyone about what does investment mean to you? One of the first steps in planning, as we mentioned, is to set goals. So when you set your goals, you're defining your dreams really for the future. And some of those goals might be things that you want to do a long ways off, like pay off your credit card debt or buy a new car. Others might be things that you'd like to do in the near future. And as we're balancing our goals and our objectives, it's important to have both a time frame around our investments and then a better understanding of the risk that comes with different time frames. So your goals are really the foundation to your financial plan because you need to know what you want to accomplish before you can begin saving or investing. Then once you've identified and prioritized your financial goals, you can then develop a clear-cut savings or investment strategy that can help you turn those dreams into reality. So when we work with our clients to set goals, we like to use the acronym SMART. And the SMART technique is an acronym that stands for specific, measurable, attainable, relevant, and timely. So first we talk about a goal that's specific, is one that's clearly defined and it's described in detail. So precisely what would you want to accomplish? I want to save for my college education is a really common goal that I hear, but it's not really a specific goal. When we talk about being specific for purposes of developing your plan, we might want to say, I'd like to save for the cost of 4 years at the University of Utah, my alma mater, by the time my daughter turns 17. That is a specific and clearly defined goal. The next step is that goal measurable, in that you should be able to track your progress and know when you've reached it. For example, I want to retire early is not a measurable goal, but I want to retire by my 55th birthday is a goal that is definite and has a definite endpoint. The next part of SMART goals is attainable. Is the goal realistic and reachable? Goals can be challenging, but you should actually have a fair chance of achieving that goal. So for instance, I'd like to save $1 million in 5 years is generally not attainable for most people, but if I'd like to save $1 million over 30 years is actually attainable if that goal is defined early enough and the right steps are taken. Finally, the next one is relevant. A relevant goal is one that makes sense to you and reflects your specific needs and your values. So goals that are relevant are goals that you'll be excited about because they have an important meaning to you. For example, I'd like to save $25,000 for a down payment so I can own my own home is an example of a goal that might be relevant. And then finally, a time frame. A time frame or a deadline for reaching your goal is also very, very important. We often hear people say, I'd like to save, or I'd like to invest, or I'd like to pay down debt. But when that time frame isn't really concrete, it's very easy to let daily things get in the way of some of those longer term goals. So when you write down your goals and you start to think about what they are, it's important to put these parameters around them and then also to start to prioritize those. Another piece of this is prior to investing, it's very important that you have an emergency fund. As Chad starts to go through his part of the presentation, you'll see that different types of investments have different time frames. And as we look at an investment that might have more risk and also needs more time to play out, it's really important to know that if you're going to have to continue to go to that investment and take money from it, it really can cause a lot of harm to your long-term financial plan. So when we think about an emergency fund, it's really just money that's readily available to meet unexpected expenses. And it's a foundation for really any successful plan. How much you should have in your emergency fund is highly dependent on you and your needs. I think one of the popular rules of thumb that you'll hear is that you should have an emergency fund equal to 3 to 6 months of your living expenses. But for some people, 3 to 6 months might be more than they need, and then for others, that might not be enough. Some of the things I encourage my clients to think about is how stable is your income? Do you work in an industry where layoffs are common, or are you in a growing field where you could replace that income very quickly? Also, do you have adequate health and disability insurance and other assets that you could tap into in an emergency without a penalty? Another item to keep in mind is where you keep your emergency fund. Obviously, keeping your money in a jar is not the best place for it, but also you need to keep it somewhere that's relatively liquid and that you could access very quickly without having to worry about is it the right time on the market to take this money now. And with there, we're going to next move into a few fundamentals of what is investing. I think some people, when you think of investing, think of speculating or gambling, and there's a lot of the investments we hear about in popular press that definitely had that kind of element to them. People are looking at getting high returns in a short period of time and trying to time the market to get the best return from it. And that's a form of investing that we really would say isn't necessarily investing but speculating. I think other people see it as a long-term methodical way of saving for the future. And in reality, if we think about it, investing is a little of both. All investing involves some amount of risk, including the potential for the loss of principal, and there can be no ironclad guarantee that any investment strategy will be successful. But with that, investing also involves the potential for growth of your money over time. So as you consider investing in a carefully planned and prepared approach and managing and accumulating money, it's important that you also come to that with the discipline and patience to meet those goals, but also understanding it does not have to be difficult. Another thing with investing is sometimes the fear of loss of principal or the fear of your principal, your core amount moving up and down, forces some people to say, well, I would just like to keep my money safe. And by safe, I mean I'll keep my money in cash and then my money won't lose its value. I think it's important to understand the concept of inflation when it comes to investing. Inflation has had the effect of reducing the purchasing power of your dollar over time. So according to the U.S. Department of Labor, the average annual rate of inflation since 1914 has been approximately 3%. We know there have been hyperinflationary periods. We've been in a period of relatively low inflation, but on average it has been 3%. So if you think about 3%, something that costs $100 today, 20 years from now would cost $181. So let's say you have $200,000 stashed in your mattress. Assuming 3% inflation, that $200,000 will buy just over $108,000 worth of goods and services in 20 years. And it will buy less than $60,000 in goods or services in 40 years. So what this means is if your investments aren't keeping up with inflation, you are actually losing money in the form of losing purchasing power each year. And it also means that the real rate of return on your investments may be much lower than what you think you're earning on them. At the same time, sort of the opposite but equally important concept of this is the concept of compounding. You can never start investing too soon, as long as you're financially ready and prepared for it, but the effect of compounding and the benefit of investing over time can't be understated. So inflation has the general effect of reducing the value of your investments. Compounding has the general effect of increasing the value. So if you have a savings account, anyone who's had one will understand the basic concepts of this. You put your money in your savings account, it earns interest, and then that interest is added to your account balance. Subsequently, the next time interest is calculated, that interest also earns interest, and in turn, you're compounding that value over time. So for example, let's say you invest $5,000 per year for 30 years. After 30 years, you will have invested a total of $150,000. Yet, assuming your funds grow at exactly 6% per year, because of compounding, after 30 years, you'll have over $395,000. The rule of 72 is a really quick way to help you estimate how long it will take an investment to double in value through compounding. So divide the number 72 by the rate at which an investment will increase in value. This is the result is the number of years that it will take an investment to double. All right, so for example, if the expected annual return on an investment is 3%, it should take about 24 years for the investment to double in value. So if we think about some of our more conservative investments, it's even hard now to earn 3% on cash, but if we thought about a 3% rate of return, we wouldn't double our money until 24 years from now. You can also use the rule of 72 to estimate the rate of interest that you would need to double your investments. So just divide 72 by the number of years. For example, in order for an investment to double in value in 4 years, you would need a return of 18%, or 72 divided by 4. So as we said, like all investments, sooner is better. The sooner you start investing, the more time your investments will have for potential growth. And waiting too long can make it very, very difficult to catch up. So for example, in this example, if we invest $3,000 at the end of each year, starting when you're 20 years old, you will have accumulated almost $680,000, assuming a 6% annual growth rate and no taxes, by age 66. If you wait until age 35 and start investing $3,000 annually, you'll only accumulate about $254,000. And if you wait until 45 to start investing, you'll accumulate about $120,000 by the time you're 66. So the takeaway here is, although it's never too late, and I don't want anyone on the call to be discouraged, I'm also simply trying to say that it's really important that you act sooner rather than later if you'd like to meet some of those longer-term goals. And finally, it's important with any investment you make and any investment decision you make that you identify your timeline and your goal horizon. So most of us invest to accumulate for retirement, a child's education, or maybe some shorter-term goals. Of course, you may have all of these things as investment goals, or some that I haven't even mentioned. But if you have multiple goals, think about how you might prioritize them. Once you've identified and prioritized your investment goals, consider the time horizon associated with each goal. Generally speaking, all else being equal, the longer your time horizon, the more aggressively you may be willing to invest. And these investments may carry more risk, and I think Chad will talk us through what we mean by the risk spectrum when we pick different investments for different time horizons. But the longer the investment horizon, the more time you will have to recover from any intermittent variation in those investments. And the final piece I will cover is around your risk tolerance. If we think about the world of investing as being very subjective, i.e. the investment plan that's right for you depends largely upon your level of comfort you have with risk and your goals, you can't completely avoid risk, but it is possible to manage it. There are two aspects of risk tolerance to consider. The first is the capacity of your investment plan to absorb losses, and then the second is how comfortable are you personally with risk. The first aspect can be quantified. The more flexibility in your investment plan when it comes to potential loss, the more risk you can tolerate. For example, as we discussed, the long-term horizon might allow you time to take advantage of some of the ups and downs in the market. The second aspect, though, is how comfortable you are with risk. It is more of an emotional measure than a numeric one. It depends on a lot of things, too, your objectives, your life stage, your personality, and your comfort or your level of investment experience. Some investors are more comfortable with a high degree of risk, while others really can tolerate only minimal risk. I can't stress enough how important it is to have this conversation with your investment advisor before you invest, after you've invested, and along the way, because a really good investment plan has certain time horizons and certain expectations built in. And if we have a downturn and you're going to emotionally have a hard time writing that out, your investment advisor needs to know that, because regardless of how good the plan is, it may not be the right plan for you. So if we really put our investors often into three categories for discussing risk, we talk about aggressive, those with a high degree of risk tolerance. We talk about moderate, those who are willing to accept some degree of risk. And then the final one is the conservative, those who are very, very risk averse. So with that, I would like to hand it over to Chad to start walking us through some of the specific investments that are out there and the risk spectrum that they fall on.
Thanks, Rebecca. Good morning, everyone. I thought what I would do, as Rebecca mentioned, we're going to walk through some of the basic investment vehicles that are available, but I wanted to dovetail that into the idea of risk versus return and continue on that theme first before we get into any of the specific investment vehicles. So, I think most people can understand when it comes to investing, there is a direct relationship between risk and return. In general, as the potential for return increases, so does your level of risk. Or stated another way, the less risk an investment has, the lower the potential for return. An example we like to give here is putting your money into a bank CD may have little risk, but it also offers less potential for return than purchasing something like common stock, which is a vehicle we'll cover here in a minute. This is true for investment portfolios as well as for individual investments. So when you think of individual investments, they carry risk, but then as you put them together in a portfolio, that entire portfolio will also cover risk. So the more aggressive you are as an investor, the more risk you may be willing to take on. And back to Rebecca's comments a little earlier. Conversely, if you're a more conservative investor, you're less likely to take on risk, but at the same time, you will have the potential for less return. As much as we would like to have things both ways, less risk, greater return, there is a direct relationship between the amount of growth you can generate versus the amount of stability in a portfolio versus the amount of income. And unfortunately, when you move closer to one of those three objectives, you start to move further away from the other two. So we refer to that as the risk-return trade-off. And the key is to try to maximize the level of return that is comparable or at least in line with your level and comfort for risk. The more comfortable you are with the level of risk in the portfolio, the more comfortable you will be with the potential outcome or the results of that portfolio. So with that said, let's start to cover some of the basic investment choices that are available. There are several general categories of investments to choose from and countless specific investments within each option or each category. The ones that we're going to cover today, we're going to start kind of as a building block mentality. We're going to start least risk and move our way up to those investments that carry greater risk. So we have our cash alternatives, we have bonds, stocks, other investments. These would be items like real estate or commodities. We're not going to spend a lot of time there. We are going to cover funds, but before we get into any specific investment vehicles, I want to make a notation here that 401ks, oftentimes we hear 401ks, IRAs. Some of you may think that the 401k plan at work is actually an investment. It's not. It should be viewed, and IRAs should be viewed more as accounts or buckets by which individual investments are held. They themselves are not individual investments. What these investment vehicles do, though, and it's important to understand, a 401k plan is a tax-advantaged vehicle. So that holds individual investments that, for tax purposes, won't be taxed until the dollars come out. We're not going to discuss specific tax treatments of investment vehicles today. I just want to make this notation here. However, it's an important subject that you really should understand the tax treatment of each vehicle or each individual investment that you're going to participate in. The best way to understand that, one, is to read whatever available information for that investment, whatever available information there is for that investment. Make sure you have that on hand. Also, talk to your financial advisor or your tax professional. They'll be able to help you better understand the tax treatment for each vehicle.
And Chad, for the listeners on the phone, we have a couple of webinars that were done last year as well. And one of them, Retirement Planning 101, covered more of these types of vehicles in more detail. So those are available on our website as well, if you'd like to go back and revisit some of those.
Thanks, Rebecca. Yeah, when you get into tax considerations and different account structures, it is important to to work through each one individually and make sure they're applicable to your situation. So with that said, let's start into the individual investment vehicles that are available. And we're going to start with the cash and cash alternatives. Cash alternatives are relatively low risk, short-term, and generally fairly liquid. In other words, you can convert those to cash quickly if you need to. You might use cash alternatives in certain situations where you need to provide some relative stability for yourself or to maintain a ready source of emergency cash. Again, back to one of the planning concepts that Rebecca had mentioned. Or it may serve as just a temporary parking spot for assets that may be deployed into other investment vehicles or used at some other point in the future. A few examples of cash alternatives include CDs, so certificates of deposit, money market deposit accounts, money market mutual funds, and U.S. Treasury bills, also known as T-bills. Each option offers different rates of return and varying levels of liquidity. This is an important distinction as well. Also, some cash alternatives such as CDs and deposit accounts may offer FDIC insurance. Others do not. Be sure you understand the type of protection available for each cash alternative. That is a key distinction. Some are insured, some are not. So let's talk in terms of advantages and disadvantages of this particular vehicle, the cash alternatives. The advantages of investing in cash are fairly evident to most people. You receive reliable, predictable earnings in the form of interest and easily tap into those funds. They're liquid, as we mentioned, highly liquid. You can have the cash in a short period of time, and there is very little risk to principal. The big trade-off here, of course, is that the return you'll receive on these investments is relatively low compared to the potential return offered by other investment vehicles. In fact, the possibility exists that the return on these investments will not be sufficient to keep up with inflation. So going back again to a chart earlier in the presentation, inflation can erode purchasing power, and these vehicles may not be able to keep pace with inflation. Let's talk a moment about bonds. Bonds are essentially loans, which is why they're called debt instruments, oftentimes referred to as debt instruments. You as the investor are lending money to a government or a corporation. The interest rate or coupon rate, as we refer to it, which can be fixed or floating, is set in advance. And interest rate payments are generally paid semi-annually, but again, it's specific to the individual investment that you're purchasing. Bonds are issued in denominations as low as $1,000. In addition to a set interest rate, there is a maturity date that is fixed. Oftentimes, maturity dates will range from 1 to 30 years. However, bonds don't need to be held until they are mature. Once issued, they can be traded among investors like any other type of security. So there are exchanges where you can buy and sell existing bonds. Because you can buy and sell in the open market, bonds will fluctuate in price, selling at, above, or below their stated face value. If interest rates rise and new bonds and investment options are offered with higher interest rates, and existing bonds with lower fixed interest rates become less appealing, then the prices will change. It's an inverse relationship with interest rates. So as interest rates rise, existing bond prices will fall to compensate for the higher prevailing interest rates at that time. Generally, the longer the bond's maturity date, the more volatile or more susceptible it will be to changes in interest rates as well. So that's important to understand. So let's take a look here at some of the advantages and, well, excuse me, we'll start with types. Let's talk a little bit about the types of bonds, and then we'll cover the advantages and disadvantages of bonds. The most common type of bond issuance you'll see are in the form of U.S. government securities or agency bonds, municipality bonds, and corporate bonds. We'll start with the U.S. government bonds. U.S. government securities, as you might expect, are backed by the full faith and credit of the United States government, and therefore carry minimal risk. We've already talked about the Treasury bills on the cash side of things, but there are other Treasury securities, including the Treasury notes and bonds, which both pay interest semi-annually, again, offered by the U.S. government. You can also invest in bonds that are issued by agencies owned or sponsored by the U.S. government, which may or may not have backing from the U.S. government itself, depending on the agency. Municipal bonds, often referred to as munis, are issued by local governments such as states, cities, and towns. Specific authorities like a state transportation authority may also issue bonds. Corporate bonds are issued by private companies. So again, we've gone with the building block mentality in terms of risk. So starting with the least amount of risk, we have U.S. government securities, and now we're moving to corporate. The volatility of these bonds depends upon the companies that issue them. So here again, risk return, there may be more risk with an individual company, and they can range from very stable to highly volatile. The highly volatile side often is referred to as junk bonds or high yield. Some corporate bonds are convertible and can be exchanged for shares of the company's stock. So this is something important to think of too, is if it can be a convertible bond. You can also purchase zero coupon bonds that are issued at a discount below face value. No interest will be paid on a zero coupon until the maturity date of that bond, at which time you'll receive the full face value of that bond. For example, you might pay $600 for a 5-year, $1,000 zero coupon bond. At the end of 5 years, you would receive $1,000. So you paid $600, and at the end, you receive the full $1,000. Now, as I mentioned, we'll get into some of the pros and cons here, the advantages and disadvantages of owning bonds. Bonds aren't as safe as cash alternatives, nor are they as glamorous as stocks or commodities, but they're an important component of most investment portfolios. Bonds can provide a steady and predictable stream of income, though interest payments for as long as you hold them can be variable in that if you buy and sell bonds, you can have a varying degree of impact. As we mentioned, they trade on the markets. So if you're buying and selling existing bonds, you may have different forms of interest payments. Bonds may also help you to diversify your investment holdings. Bond values tend to move opposite direction of the stocks. There is somewhat of an inverse relationship between the two. By holding both bonds and stocks in a portfolio, you might be able to offset losses in one asset category, asset categories being stocks versus bonds, and you may have gains in another asset category. So gains and losses may be able to offset each other. That's not 100% correlation, but oftentimes diversification does help. With a bond, you can lose money if the issuer fails to make interest payments. This would be one of the disadvantages. The value of the bonds will fluctuate with interest rates. We mentioned that. And many bonds are issued with a fixed interest rate. As general interest rates fluctuate, so too will the value of those bonds. If interest rates drop, again, you have a rise in the price. If interest rates rise, you have a drop in the price of that bond. Finally, because bonds have a relatively lower risk than other investments, such as stocks or commodities again, they also tend to offer relatively low returns. So on the risk-return spectrum, less risk, less return than some of the vehicles we're about to talk about. So continuing our path up the risk-return spectrum, we get to stocks. When you buy a company stock, you're actually purchasing a share of ownership in that business. The greater the number of shares you own, the higher the percentage of ownership you have in that company. Investors who purchase stock are known as the company's stockholders or shareholders. Your percentage of ownership in that company also represents your shares of risk taken and the profits generated by that company. If the company does well, your share of the total earnings will be proportionate to how much of the company stock you own. So you're actually participating in the growth of that company or the performance of that company. Beyond that, depending on the company and the type of shares you have, stock ownership may carry other benefits. Specifically, you may be entitled to dividend payments, so this is another form of income, which you can generally receive either in cash or additional shares. Capital gains payouts and other corporate privileges also come with stock ownership. For example, common stock owners have the right to vote for candidates for the board of directors and other important issues. If you purchase stock, you can make money in one of two ways. First, corporate earnings may be distributed, again here in the form of dividends, usually paid quarterly. And then secondarily, you can sell your shares. If the value of the company's stock has increased from the time that you bought it and you sell it to someone else, you can make a profit for the difference of the two prices. Of course, if the value of the stock has declined and you sell it to someone else, you will have a loss versus a gain. So you do have the potential for loss by owning common stock. So let's talk about some of the varying nuances of stock and stock ownership. Generally, corporations may issue two types of stock, and here we have them listed, common versus preferred. Common stock holders have certain rights. We discussed that on the previous slide, including the right to vote. However, common stockholders are last in line to claim the earnings or assets of a company. They receive dividends at the discretion of the board of directors and only after all of the other claims for profit have been made. So, for example, you are not issuing debt to the company when you buy their stock as if you were by buying a bond. So if in terms of profits or assets of the company, bondholders actually have claim to the assets and profits of a company first. Bondholders need to be paid first before common or preferred shareholders receive their dividends. Preferred stockholders are given priority over holders of common stock when it comes to the dividends. However, they do not have the right to vote. And this is a big distinction between the common and preferred. The preferred stockholders will typically receive a fixed dividend payment, however, usually on a quarterly basis. And for preferred stockholders, there is less return potential than for the common stockholders. So moving beyond the two types of stock, let's take a look at some of the categories that we place on stocks. Categories being small cap, mid cap, and large cap. By cap, we're referring to capitalization, and this is some industry jargon that we use to really determine size of company, small, medium, and large in this case. And capitalization is the number of shares outstanding times the price, the current price of the stock. That gets you to the capitalization. As you can imagine, the size of the company does have an influence on the risk-return characteristics of that stock. So typically speaking, smaller companies will carry greater risk than larger companies. Again, generally speaking, and each company will have its own nuances and will require its own amount of research to determine the specific levels of risk. But in general, small, medium, and large companies carry different risk profiles. So once we've broken stocks down into some of the categories, we also will look at some of the general stock terminology that is out there and that you might encounter are things like growth stocks, value stocks, income or blue chip, and what's referred to as an American Depository Receipt or an ADR. So working through the terminology, growth stocks and value stocks, these are the two general either perceptions or disciplines within stock investing. So in one case, for growth, the growth stocks usually are characterized by earnings that are increasing at a faster rate than their industry average or the overall market. So they're on a growth trajectory. While value securities or value stocks, investors see some perceived value in those companies. and most of them would be selling at what is perceived to be less than their typical multiples, and the multiples that we would be looking at are company sales or earnings or the overall book value of the company. If they appear to be selling at a discount to any of those, they may be considered a value stock. So again, growth stocks are considered to have a growth trajectory characterized by earnings that are increasing at a faster rate than the overall industry or the overall market. And value stocks are trading at what is perceived to be a discount. Income stocks are those stocks that typically pay higher than average dividends. The income that you're going to be generating from a common stock will be in the form of dividends. So there are typical or traditionally dividend-heavy securities. They'll pay consistent and larger than average dividends. However, there are some trade-offs to that. With the income component comes less of a capital appreciation or being able to have that stock purchased at one level and sold at a different level. They tend to grow more slowly than others. The blue chip stocks, on the other hand, are stocks of well-known companies with good reputations, strong records of profit. They too will generally pay dividends, but not as high as something considered an income stock. Finally, we have American depository receipts. American depository receipts, which are negotiable instruments created to represent shares of stock in non-U.S. companies. So this is where non-U.S. companies, international companies, will create essentially stock here in the form of American depository receipts for U.S. investors to be able to purchase. Cover some of the advantages and disadvantages to each. With stocks, you historically have better potential for longer term returns. So in the short run, there will be what we refer to as volatility or fluctuation in stock prices, but over longer periods of time, you do have a greater potential for return. You have ownership rights, like we've talked about. You can vote for things like the board of directors or key issues. Those votes are handled in the form of proxy voting. So if you do own a stock, you will receive proxies in the mail that you may vote. And they can provide income through dividends as well as the potential for capital appreciation. And they're easy to buy and sell. There are numerous exchanges by which you can buy and sell. So some of the disadvantages are obviously if a company has poor results or the company itself is not doing well, the dividends and the value of those securities will suffer. They're subject to market volatility. Again, here in the short run in particular, prices will fluctuate. There's a greater risk to your principal. This would be defined as loss, so you have a greater potential for loss. And you may not be appropriate for the short-term investors. Certainly if we're thinking in terms of our emergency funds or any short-term needs, the stocks may not be the most appropriate vehicle for those buckets or for those goals. So I mentioned at the beginning of my comments that we would cover some of the other investments, and I don't want to spend a lot of time here because there are a whole host of other investment vehicles that you can participate in, but we've listed a few here: real estate and stock options, futures, commodities, collectibles. There's a varying degree even within each of these categories of investments that you can participate in. So one of the more common vehicles that we run into in our industry is mutual funds. And I think most investors, this is probably the starting point for investing into things like stocks and bonds. But let's better define a mutual fund before we get into some of the specifics. So in a mutual fund, your money is pooled with other investors. You own the participation in that pool in the form of shares. So you own shares of the mutual fund, and then the money that you have used to purchase those shares is included in this pool, those funds then are invested according to the mandate of the mutual fund. So the investment strategy specific to that mutual fund is where the dollars will be invested. And as I mentioned, with each investment, there are certain levels of information available. With a mutual fund, and you probably have even heard this on some of the commercials, the tagline is, before investing, investors should carefully consider a fund's investment objectives, risks, charges, and expenses. That's probably something you may have heard or certainly will hear as you start to invest in things like mutual funds. Each mutual fund will carry a prospectus with it that you have, as a mutual fund provider, you have to offer a prospectus. We recommend to our clients that they receive the prospectus and review the prospectus for their mutual funds. Mutual funds, the interesting thing about mutual funds is they actually cover all of the previous vehicles we had talked about. So you may purchase a mutual fund that buys money market securities or cash-like securities, bonds or bond-like securities, or stocks. You may also have a mutual fund that buys a combination of all of those three or two of those three, and we refer to those as balanced funds. Finally, there are also international funds that you can purchase. And as you can see, they all cover the spectrum of risk versus return. The last thing that I will mention is active versus passive management. Active mutual funds are managed by a portfolio manager or a group of portfolio managers, and what makes them active is that they are buying and selling within that portfolio based on their investment strategy, whereas a passive investment vehicle or a passive mutual fund typically is tracking an index. And so the purchases and sales made within that mutual fund are to reflect a specific index. So you have active managers that are buying and selling, and passive managers that are basically following an index. Quickly, here are some advantages and disadvantages of using mutual funds. Of course, the advantages are the diversification. You have some professional management involved. You can typically participate with smaller dollar amounts. And there is a lot of liquidity. These trade on a daily basis. Mutual funds are highly liquid. Some disadvantages, however, are that the values can fluctuate because they trade and they're based on the underlying portfolio. There is fluctuation in the price of a mutual fund security, in this case the form of a share. Portions of fund dollars are typically held in cash. Managers, because you have investors coming and going from mutual funds fairly regularly, they will carry cash in the portfolio. There's the potential for tax inefficiencies, again, probably beyond the scope of this conversation, but something you may want to talk about with your investment professional is how a mutual fund could impact your tax picture. And of course, there are mutual fund fees and expenses associated with these pooled vehicles and having the professional management involved. Let's talk about exchange-traded funds quickly. They're very similar to a mutual fund in that they are a pool of underlying investments. They trade with shares, but most ETFs would be considered passive because they're index-based. They will carry a lower cost structure than an actively managed mutual fund, and they may actually provide some tax efficiency. And the big difference between exchange-traded funds and mutual funds is that exchange-traded funds will trade throughout the day, whereas a mutual fund will only trade at the close of business on any given day. Again, here, before investing, investors should be careful and consider the fund's objectives. Also, you may receive prospectus information on exchange-traded funds. So now that we've covered some of the basic building blocks of investments and the investment vehicles that are available, let's talk quickly, and I want to make sure I leave enough room for questions and answers. But let's talk about a couple of the different strategies you could deploy and maybe what a portfolio or a combination of these investment vehicles would look like. One of the methods that is most common, and this is something that whether you realize it or not, you may be doing with your 401k plan, and that is dollar cost averaging. In a dollar cost averaging scenario, you're investing the same dollar amount on a regularly scheduled interval, so that could be every 2 weeks or once a month. And with that dollar amount, because certain assets will fluctuate, that dollar amount may buy more shares than the last time you invested or less, depending on how certain investments have done. But over the longer term, the average cost of shares will come down over time typically, or be, in this case we say lower than average market price on average. So the example given in the chart, 10 shares at the first time you invest, the price has gone down. Because you're investing the same dollar amount, you now have the ability to buy 30 shares at the next interval, so on and so forth. And then when you combine those, you should have a lower cost of purchase than average. The second thing to consider, or part of the methodology of building a portfolio, is asset allocation. We referred to asset classes earlier as being stocks or bonds, and that would contain or pertain to cash and stocks, bonds. You can also think in terms of international securities and those other investments, but those are what we refer to as asset classes. So things to consider when you're looking at putting various asset classes together is how much diversification are you creating? What is your overall risk tolerance and time frames, back to the planning aspect, and what are your liquidity needs in your personal financial situation? So if you have a general idea of what your planning needs are or what your personal financial situation and liquidity needs look like, we can start to put these asset classes together to reflect the amount of risk tolerance you have, the time frame that you're looking at, and the diversification needs of that portfolio to get you to those goals. So here we've created a couple of sample illustrations of what asset allocation might look like, and we've started with a conservative model. So here a conservative model is going to be built using those investment vehicles that tend to carry less risk, again generate less return, but carry less risk. So we have 25% of the portfolio in cash alternatives, 50% in bonds, and then the remaining 25% is in stocks. The reason we would do it this way, one, you have those risk-return trade-offs and the somewhat inverse relationships between a couple of these asset classes. So when stocks are doing well, bonds may not be. When bonds are doing well, stocks may not be. But we also carry stock in a portfolio like this because that helps us hedge against inflation, or at least have expectations of outpacing inflation in a portion of our portfolio. So moving up the risk spectrum, you can see moderate, and all it really is just changing the asset classes from 50 to 40 to 10, and increasing our level of risk, but also increasing our potential for return. This would be a case of probably our most aggressive, or one of the more aggressive portfolios we would construct, where 75% of the portfolio is in one asset class, and that would be stocks here. So the last slide I'll conclude with, and we'll move to questions and answers here, is the role of a financial professional. We believe that it is important for individuals to sit and talk through what their current financial profile looks like, as well as what their liquidity needs are, what their goals are, and a financial professional can help you better understand how to take those needs and goals and expectations and distill them down into a portfolio. They can also help manage and monitor portfolios, and they can coordinate conversations with other professionals, such as your tax professional. So we believe it is important to participate in webinars like this, learn as much as you can, but also sit and talk to a professional. So with that, I'm going to move, and I want to be respectful of time here, so we're going to move into the Q&A session, and we have a couple of our questions already queued.
Sure, so Chad, I'll go ahead and I will take the first one. The first question was, if submitting the maximum amount allowed to a 401k or IRA, what would be the next best investment option for saving for retirement? So this is someone who is taking full advantage of the tax-deferred vehicles that are out there. And although there are a variety of options, this is normally now the point where someone sets up a regular investment account, a regular taxable investment account. And then how you invest that will go into that time horizon, what you're trying to accomplish with it. And then also the tax management around it becomes more important. So the types of investments that your advisor might recommend may be a little bit different as well. And then the next question was, on a zero coupon bond, are taxes on the increase assessed at maturity? So a zero coupon bond is a bond that is sold sort of at a discount, meaning that it doesn't have a coupon, so you pay less for it. And by coupon, we mean interest rate. As a general rule, the interest is recognized over the life of that maturity. But with anything that comes to taxes or tax decisions, we always encourage you to make sure that your CPA is familiar with the investment and is aware of it, and then take their guidance on how to go about recognizing that interest. All right, so can you show the moderate investment pie one more time? So Chad, I think you still have control over that, and I'll go ahead and hand that one over to you.
Okay, so here is the moderate, and we did go through these fairly quickly. What's important to understand about an asset allocation model like this, or any of the models that I've shown, is that consider this a starting point. And as things change, whether that is directly reflective of your situation or just a function of the markets, these percentages may change. So as your risk tolerance fluctuates, so too may your asset allocation. But if we think of the movement of stocks in particular, the value of those stocks fluctuates over time. And so that 50 may become 60, or it also may represent 40% of the portfolio. So it's important not only to think in terms of where you start with a portfolio like this, but how often you rebalance or come back to a particular asset allocation in terms of the percentages. So if we use this as our baseline and a year from now things have changed, we may want to rebalance the portfolio back to what we consider our baseline. In other periods, and this again is where we want to make sure we're working with our clients and discussing what their current needs are on a fairly regular basis. If, for example, we've gone to a 60% stock allocation because the stock market has done well, we may want to continue with that and stay at 60% or again rebalance. But we consider the models a starting point, and they do fluctuate and change over time.
All right, Ted, we have another question. Does Zions have financial professionals we can meet with, and does Zions offer these investment accounts that you mentioned?
The answer to both would be yes, and we certainly can help get you in touch with the investment professionals within Zions. I think probably the best way to do that, since we do cover such a large geography relative to our bank, you can either look for a Zions Wealth Advisor in your market or contact us and we can help direct you to who that person is. A number of our advisors cover multiple banking locations, and we certainly can make sure we get the right advisor for your location. And then, yes, we do offer a wide range of investment vehicles, and that advisor can help you with those.
All right, another question is, what is the maximum amount to contribute to a 401k annually? So this amount tends to change each year based on inflation. And so for 2015, for individuals who are 49 and under, you can put up to $18,000 into a 401k. There's also something called the catch-up contribution for individuals who are age 50 or older, and that allows an additional $6,000. So if you have the maximum amount under is 18, and then over 50 is 18 plus the 6,000.